All right, today we're diving deep into what really makes for a powerful swing trade. And let me tell you, it's not about luck or just guessing. It's all about learning to see and understand the invisible currents that drive the market, what we call market flow. Hey everyone, and welcome to AI Explains ICT. In this video, we're tackling the core content from month 6, episode 1. And this month, it is all about swing trading. Seriously, you're going to want to grab a notebook for this one. The concepts we're about to break down are so fundamental, they could completely change how you look at the markets.
So here's the game plan. First, we'll get crystal clear on what swing trading actually is. Then we'll get into the 3 market profiles that govern literally everything price does. After that, we'll walk through the top-down analysis. This is how you spot the big dominant trend. We'll look at some charts to see a good market versus a bad one. And then, the best part, we'll see exactly how to find your opportunity to get in.
All right, let's kick things off. First things first, what are we even trying to do as swing traders? What's the goal here? Because it's a very specific discipline with a very clear objective.
So swing trading, it's really an intermediate term game. We're not talking about quick in-and-out scalps or day trades. No, we're looking to hold positions for 2 weeks, maybe even longer. And you might be asking, why so long? Well, it's because our whole goal is to ride the big waves, the major price moves that are being pushed by the large institutions, the smart money. And the payoff for that patience, it can be huge. By getting in sync with these massive market flows, we're talking about targeting moves of 200, 300, even 500 pips from a single setup. Now that's the kind of potential that makes being patient and waiting for the absolute perfect conditions totally worth it.
Okay, so if we want to catch those big moves, the first step is to figure out what kind of environment the market is even in right now. Because trust me, not all market conditions are good for swing trading. They're definitely not created equal.
Now, according to ICT, every single market, doesn't matter the asset, doesn't matter the time frame, is always, and I mean always, in one of 3 states. He calls them profiles. And getting a handle on these is just, well, it's everything. It's the foundation of our entire analysis. So what are these 3 profiles? You've got consolidation, that's when price is just stuck going sideways, range bound. Then there's reversal, where the direction is clearly shifting. And then there's the one we care about most, trending. Now, as swing traders, this trending profile is our bread and butter. It's where we see those beautiful, clean phases of expansion and retracement, and that's exactly where our best opportunities live. So that leads to a pretty obvious question, right? If we've got these 3 market states, which one should we be hunting for? Where do we focus all our attention? The answer couldn't be simpler. We follow the big money. We follow the large institutional flows. And the most obvious sign that this smart money is active is in a trending market. Think of it like this. When the big institutions decide to move, they leave giant footprints in the market. Our job is just to find those footprints and walk in the same direction. Okay, that sounds great in theory, but how do we actually find these trending markets? Well, we do it with a very specific step-by-step method called top-down analysis.
In this process, it's incredibly simple but so powerful. You start at the very top. We're talking the monthly and weekly charts, and you just ask one simple question. What is the most obvious dominant trend here? As soon as you see it, that's it. Your directional bias is locked in. So for example, if that monthly chart is screaming bullish, then we are only looking for buys. We become buyers, period, no second guessing.
And look, this isn't just some casual tip. This is the absolute core of the entire strategy. ICT says it best. He says, if the aim in swing trading is to position ourselves in moves that are likely to move at large distance, we should be looking for markets that are trending. It's as simple as that. All right, enough talk. Let's actually see what this looks like on the charts. Because the difference between a good market for swing trading and a bad one, well, it becomes crystal clear when you see them next to each other. So check this out. This is the euro/dollar on the monthly chart. And just look at it. What's it doing? Pretty much nothing. Right? It's not really going anywhere. Price is just stuck, chopping around inside a range. This is the definition of a consolidation profile. It's basically telling us the market has no real interest in going higher and no real interest in going lower. As a swing trader, this is a place you want to avoid. Okay, now, look at this. This is the New Zealand dollar. The difference is night and day, isn't it? This is what a beautiful trending market looks like. You see that clean series of higher highs followed by higher lows? That right there, that is a market showing you it wants to go somewhere. It's showing a clear willingness to move in one direction.
and that is the telltale sign of institutional participation that we're hunting for.
So let's just nail this down. Consolidation means the big players are sitting on the sidelines. There's a lack of institutional interest. The market's just neutral. But a trending market, that's the smoke signal. That is clear, hard evidence that the smart money is in the game. They've literally forced the market out of a range and have thrown their weight behind a specific direction. Our job is to simply get on the same side as that powerful commitment.
All right, so we've done our homework. We did the top-down analysis, we found a gorgeous trending market, and our directional bias is set in stone. So now what? What's the next step? How do we actually get into a trade?
The secret is to wait for the pullbacks. This daily chart of the Kiwi dollar we were just looking at shows this perfectly. See how after price makes a big push up, that's the expansion, it always seems to pull back a little, it retraces. Those pullbacks are our signal. That's our green light. It lets us jump into a powerful established trend, but at a cheaper price. Kind of like buying on sale, right before it takes off again. And as you can see, this pattern just keeps repeating, giving you multiple chances to get on board.
So, if we take all these pieces and put them together, what does this actually mean for you? For your trading process, for your mindset when you sit down at the charts?
It really comes down to just a handful of simple but incredibly powerful rules. Rule number 1, only focus on what is blindingly obvious on the monthly and weekly charts. If you have to squint to see it, it's not there. Rule 2, always trade with the long-term trend. Don't try to be a hero and fight it. Rule 3, just stay away from markets that are going nowhere. Avoid that chop. And finally, learn to trust this framework. Let the huge tide of the market do the heavy lifting for you. When you trade this way, you stop fighting against the current and you start flowing with its most powerful force. So the real question isn't, how do I find a trade? The real question is, can you be patient enough to wait for these crystal clear setups?
And that's our look at market flow and how to find ideal swing trading conditions. If you got some value out of this video, do me a favor and hit that like button and be sure to subscribe for more content like this. And hey, if you have any questions at all, just leave them in the comments section and a real person will get back to you. Stay safe out there and happy trading.